Hello everyone. Today we will discuss how the projects or investments are decided purely on the basis of financial terms. Like if you are evaluating a project and all other things like the technology, the trends, the consumer demands, and the expected growth in the industries have been studied and evaluated. And now there is only factor left is the financial terms. How will you decide about investment in a project purely on the basis of financials? There are many aspects that you have to evaluate, but I am discussing the five benchmarks that you must evaluate whether you are a small investor or whether you are a big investors and going for the board position in a project. The first thing that you must evaluate is the net present value. Net present value means what is the value generated by the net cash flows over the life of a project discounted at a benchmark rate. So if the net present value is positive, it means the project will be profitable. So and the project is suitable for investment. But what you have to compare about the different projects available is which project generates the highest net present value. Like if you are investing $100 million and there are two projects available, project A and project B, and both generate positive NPV, so you have to decide which has the highest NPV as compared to the other investment options available. So this is the first benchmark, that when the projects have a positive NPV, that is the project suitable for investment. The second benchmark to study is the internal rate of return. So internal rate of return is a rate where the investment growth is reflected in a project. So it means if the IRR is 10%, it means the investment in the project will grow at a rate of 10% over the life of the projects. It excludes the external factors like the capital cost, like the inflation rate. That is why it is called an internal rate of return, or commonly as IRR. The benchmark to decide is if your IRR is greater than your benchmark rate or the cost of capital, it means this is the project that is worthwhile for investment. Like the loan you borrowed with an interest rate of 9% and the project's IRR is 50%. So it means the project has a greater growth rate or the earning potential than the cost of capital. So if a project has a greater IRR than your benchmark or the cost of capital, it means the project is viable for investment. And again, on the other hand, if you have two projects or multiple projects in front of you for evaluation for investment, you must go for the project which has the highest IRR rate. So these are the two factors which normally, or you may say the every time the investor consider while making a investment decision. The third one is the return on investment, the simpler profitability on your investment you made. So if the return on investment is higher than your expected rate or the normal rate that banks in the area are offering for the similar time period as to the life of the projects, then you have to compare whether ROI is greater than this benchmark rate. If the return on investment is greater than the benchmark rate or the rate offered by the banks in the area for the similar time periods, it means the project is better than placing your money into the bank. So it means that if ROI is greater than the bank deposit rate, you should go and you should take the risk of investing your money in the project. The fourth one is the payback period. The payback period means in how many periods or in how many years your investment will be repaid by the project's cash flows. So it means if you are investing in a project and the One project will return your money in 3 years, another project will return your money in 5 years. So your preference should be for a project which have a lower payback period, which means 3 years. This is the reason because the projects with a longer payback period has a more risk attached to them. Like if you have to compare a project with 1 year payback period and another project with the 10-year payback periods. For the 1 year, you can very accurately predict the future or nearly accurately predict the future. Like right now, for the year 2024 in your country, you can very precisely determine the inflation rate, the benchmark interest rate, the GDP growth, and the other situation around you, like the political instability and other matters that are around your country or your area. But if you have to predict the future for next 10 years, then the accuracy for determination of inflation, benchmark, interest rate, and the other political stability and law and order situation, that would be very difficult to predict. Therefore, the preference should be given to the projects which has a lower payback period. And the last but not the least is the break-even point. So break-even point means at what percentage of total revenue or percentage of total inventory you comes to a point where you cover all of your expenses, and after that your projects will jump into the profitability or the greener areas. So it means if your break-even point of the projects is lesser in terms of total percentage of the sales or the quantity, it means that project has a lesser risk attached, and that is the project that you should prefer. For example, there is a project which has a break-even point at 40%, and there is other project which has a break-even point at 90%. So the projects, if face a little bit fluctuation in the results, so all of a sudden the project which have a break even at 90% of the total sale volume, there are chances that it will go to a loss all of a sudden with a little bit fluctuation in the market. While the project which has a break even point has a cushion that a few fluctuation will not affect the projects and will not convert the profitable business into a loss making unit. So again, at the end, I would like to say that if you are making a decision of investment purely on the basis of financial terms, so you have to set at least 5 benchmarks. There are many other benchmarks that you can study for the evaluation of projects, but these are the common benchmark that every investor or every VC will review in a projects, like the NPV, like the IRR, the return of investment, payback period, and the break-even point. So these are my 2 cents on evaluation of investment. Thank you very much.